Hey everybody, this is Jim at SP500chart.com. It's a little after 2:30 on Sunday afternoon, September 15th, 2013. And we're going to look at the S&P 500 chart using some time-honored techniques to understand modern markets. And the reason I say that is simple. We live in a computer age where we can look at a real-time streaming chart on a 1 minute, 2 minute, 3 minute, 5 minute, 10 minute, 15, 30, you name it. The data today is abundant and it's free. But the same things that these chartists in the 1930s, 40s, and 50s started to uncover in stock trading patterns, these same things still work today because they are created not by the computer, not by the data. They're created by the psychology of human beings. So we try to spot these patterns, try to spot these trends, and then apply them to how these things have tended to behave in the past to see if they predict how things might behave in the future. But before we actually go to that, let me remind you that the website and the video are for educational purposes only, and nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. And I am still not a licensed financial professional. I got no plans on ever being one. But I am a guy who draws lines on charts, and I got no plans on stopping that. So let's take a look. Okay, looking to start with on a 30-minute chart, a couple things I just want to point out in broad retrospect. And that is, when we broke this purple line back in the middle of August, we were expecting a move down to at least, I believe it was about 1650. Let me back up. Yeah, we were looking for a move down to about 1654, 1655 as a minimum. And the S&P gave more to the downside than that. We actually got down briefly under 1630. When we started to get down into that area, we ran into a trend line that had been on our longer term chart right here, this turquoise line, which is defined by the November 2012 lows and the lows that were set in the, I believe that was the third week of June of this year. We came down to that line with the idea that we may set up a reversal here. Okay, I'm going to fast forward now. When we were in this area, we juked and jived around a little bit. We drew this trend line with the idea that a move over this line would likely set up some form of a rally. We broke up over that line and then back tested it, textbook back test, and then that rally has taken the S&P up off of the lows approximately 60 points. So it's been a nice little move, and now we're trying to figure out how much more is left in this move. And part of that process is to evaluate whether or not the S&P can get up to this neckline from our head and shoulders top, which should present resistance. And if it can get there, does the market have the strength to overcome that level and move up to potentially tag this blue line or get to about 1715? And you say, well, what's special about 1715? Well, 1715 would have been our target had we had a completed inverted head and shoulders here. So you say, well, but Jim, that's not a completed pattern. And I say to you, well, that's part of the reason why this is not easy. Had we had a completed head and shoulders pattern and we'd broken above it, I would probably be at this point 80% confident that we're going to make 1715. But having not had the benefit of that additional consolidation phase on a right shoulder, it just kind of makes me want to squint and go, what? So here we are. I believe it is safe, based upon the historical tendency of necklines to be technically significant into the future. Not just when they're broken, but we extend that line into the future. And here we are, about a month later, and we're trying to figure out, if we get up to this level, will it turn the S&P back? And I would just say this. I would be on the alert for that. I would consider that as a definite and a distinct possibility. I don't think I would say that it is a near certainty. Now, if we had this head and shoulders top and we'd only come down 8 points and then rallied back to this line, I would say, folks, it's going to head south when it gets there, because this pattern would not have made its minimum target. But the minimum target is a done deal. So therefore, I'm a little ambivalent. That means sitting on the fence about what will happen if and when the S&P reaches this level, which this week would be in the mid to high 1790s, and later in the week would actually be around 1700, and possibly even a little higher once we get to Friday. So let's look back at the week. Let's do our little weekly retrospective. First thing to mention is that we started Monday with a nice move up that ended just a little bit north of 1670. That happened to be at that proposed neckline area. So my thought at the end of closing on Monday is it would be ideal if we saw a selling for a few days, not deep selling, just a little bit of laziness, maybe to the downside, getting around 1660, maybe even into the high 1650s. I thought that would be the ideal situation. And I think the lesson to be learned here is when I say I think that would be the ideal situation, I think you can probably get a Sharpie pen and mark that off the list of possibilities, because it just feels that way. Okay? We've seen this time and time again. Now, in fairness to myself, I did mention that we have seen a number of inverted head and shoulders patterns lately that have failed to make that nice right shoulder. We've seen some where we've come up to this level and then we just bounce back a tiny bit, then take it out, but with a right shoulder that really is absolutely nothing in scope and scale compared to the left shoulder. And on Tuesday, that's exactly what happened. We broke up over the neckline. I also mentioned that there is a level of gap resistance that we will probably encounter. The market came up to that twice on Tuesday and got turned back, albeit weekly. W-E-A-K-L-E, weekly. And then on Wednesday, we actually rallied up over that line. And since we've just been kind of meandering in sideways fashion around that gap area, we closed a little over it. So I think that's a pretty good sign that this market has some underlying strength. And I was hoping to, by this time, be able to show you that there is some type of channel that is developing. And for the life of me, I just can't settle on anything that we're looking at on this current chart as being a clearly defined channel. That's not to say that there are not possibilities, but I don't want to put too many, quote, possibilities on the chart, because sometimes when you do that and you get a break of what you thought might have been a resistance line, you might say, oh no, sell, 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 we broke support, and then you find out, oh, well, that wasn't the right line. So I'm leaving that off. The only line I've got on here right now that is defined by trading that's taken place in the 10 days is this little light gray line. And I'll be honest with you, I don't know how important this line is, or whether it even has anything to say about what happens in the future. I just really, that this thing may be a stretch here, but it's there because it is the only thing that sorta seems to line up. So as we enter into the week, all I can say is, you know, we came into this week looking at the possibility of a move up to 1715 based upon breaking over this line that I just highlighted. We got that breakout, but because it came without that right shoulder, I'm just saying be careful. So let's see if coming into the week where we start trading on 9/16, let's see if the S&P first has the strength to get up to our neckline, which would be in the high to high mid 1690s. And if we get up there, dare we expect, or would we be surprised by, maybe that would be the better way to put it, would we be surprised by a move over this line that should produce some resistance? So, this line is probably going to produce some support. This line might produce some support. This line will probably produce some resistance. This line will probably produce a stronger chance of resistance because it actually has a fairly decent history to it. I think we got to go back to our 2-hour chart. You can see that our last two intermediate tops, well, I say intermediate, let's call them short-term. Our last two short-term tops extend out on this blue line right here. I would be a little surprised to see that get taken out. But if that were to happen, the good news is that means this bull is probably going to run significantly higher, despite the naysayers' feelings that the markets are way ahead of themselves and have no justification for being at these levels. So guys, that is your video in the weekly review for the week that ended on Friday the 13th, 2013. Turned out to be not such a bad day. No bad luck, really, at least in the markets. So, guys, thanks again for watching, and I really want to especially thank you for your very kind support. Take care.